Before you get into investing in the US market, I strongly recommend you having a talk with a cross border tax expert in Canada to understand the mechanics and understand the taxation on the US and Canadian side so you're not subject to double taxation. Hi, everyone. We've got Elliott Milek from CanUS Tax Services. He specializes in cross-border taxes. He's also part of Mada Partners and Mada Capital. And today we're just going to go over a few things that a lot of people ask us when investing in U.S. real estate. And since Elliott is a cross-border accountant, I'll let him take over and go through a few things that come up in conversations we have with people.
Thanks, Matt. Yeah, it's great to be here. We're gonna discuss kind of high level of some of the implications on how Canadians can invest into U.S. real property, essentially. Through various vehicles such as the registered accounts here in Canada, the United States, or even outside registered vehicles as well through corporations. Matt, why don't you kind of start off? I mean, how do your clients typically at this current time invest into your Philadelphia projects?
So we have a few different ways that we take on money from investors. First way is we'll create a corporation, so kind of like a joint venture with our accredited investor, depending on how long they want to invest with us. It's typically 3 to 5 years just for the structuring. It's a little heavy on the legal work and the accounting work. Obviously, you're involved in that. And also, we've just launched a bond fund around 6.5, 8 months ago, and people can use registered funds and they can invest directly in our projects in Philadelphia. It's an open-ended fund with our developers, and also people can use cash also to just invest in the fund if they want. So it can be personal or even business capital that's just sitting in the bank account, and they're just looking to beat the inflation or beat the markets.
So how are they typically structured? Are your investors primarily debt investors where they're just receiving a loan, or do you have some type of equity component as well on some of these projects? Or
it all depends. There's a few different structures. That's almost a different subject itself.
Okay.
We do have a debt component to the fund. There's also an equity portion also available on the Mada Partners joint venture.
Very good. So you do have various options for different investors, and what are your primary clientele? Are they primarily Canadians, or do you seek outside investors as well in Canada? Or
yeah, the majority of our clients are all from Canada, from basically Montreal all the way down to the East Coast, West Coast. So we typically, the beauty of having a fund, we can use accredited and non-accredited investors, but typically the people that we work with are accredited investors, but we've also ended up working with a few unaccredited investors, just with the type of products and the relationships we've had.
Absolutely. So how you structure these are going to be differentiating based on the individual, essentially, right? So I mean, individuals can invest directly into your projects. If they're just receiving a debt or an interest, obviously that interest is taxable on the Canadian side on their individual tax return. Because it's coming from the United States, there may be a withholding component that the IRS imposes. So typically is about a 15% tax withholding on the interest, but there are ways to offset that income or offset that tax by filing the necessary W-8 forms, with you. Certainly, a lot of people have holding companies in Canada as well. So if they're receiving interest on that investment, there is a withholding obligation from the U.S. Companies, but that Canadian company can offset that withholding obligation. So typically, again, the equity component is going to be a little bit more complex depending on your situation. So for the most part, if you are receiving, rental income, if you're holding those projects off for long term, if you're flipping them, obviously it's going to be considered or either ordinary income or capital gains, depending on the individual or the specific project, essentially. So that Canadian investor, whether individually or corporately, they will have to file a U.S. Tax return, basically to report that income, right? So if they have a Canadian company that has an investment into the U.S. project, that Canadian company is going to have to file a U.S. tax return to report the flip income, essentially, from that project, as well as the interest that's being received. So so these are some of the issues that you may encounter. Obviously there are some easier options for you, whether it's through your RSP or TFSA, which kind of alleviates some of the tax compliance with setting up corporations and stuff like that. So why don't you kind of maybe outline how your Canadian investors can invest through your RSPs and registered accounts and TFSAs like that? Like, do you have a secondary company that you use, or?
So we basically use Olympia Trust based out of Calgary to facilitate the transaction. So our fund, our private equity fund, that's our bond fund, is registered and recognized by them. So essentially somebody would have to have an RSP account open with them, or they can just open one, super simple to do, and then transfer it would have to open an account with Olympia Trust and transfer their funds to Olympia Trust. That process takes a bit of time with the banks, but once that's set up, it's a simple process. Again, just even through your phone, you can do it. It's just time consuming because the banks don't like guys like us that invest in private equity, so they take forever to move money around. But at the end of the day, it's a simple system and process to use, but you got to realize that it takes time just because the banks like to take their time on moving money around.
So yeah, that's certainly nice. I mean, the RSP obviously feature does attract a lot of individuals. But, it allows, a nice way to say, a more broader aspect of clientele to come into your fund, right? So, I mean, at the end of the day, the majority of capital for Canadians are held in two places: one in their house, and two in their RSPs. So, if you can actually access some of that capital and provide a higher rate of return than maybe the market would, it's certainly more advantageous to the investor. That income that you're earning, that interest income on the bonds, is tax deferred until you take the funds out. But essentially, unlike capital gains, where you do get that 50% deduction, obviously once you do take the funds out of your RSP, at a later date, it is taxed at your ordinary rates, essentially. So you're not getting the preferential capital gains treatment. But keep in mind, you do get to defer that interest and that equity essentially until you take the funds out of the RSP, 10, 20, 30 years down the line. Do you guys allow TFSA options as well, or?
Absolutely. So any registered account in Canada qualifies for our bond fund. So that's why we have a partnership with Olympia Trust to help us facilitate that.
Certainly. Yeah, no, I mean, that's really a nice feature as well. I mean, obviously you don't get that RSP deduction like you would by contributing to an RSP. So the funds you are contributing to your TFSA are after tax funds. But again, you get to take those funds out of the TFSA, whenever you want, and not have to incur income inclusion once you do take the funds out. And as long as you stay a Canadian resident, that income is tax deferred essentially while it's within the TFSA. So if you are getting a better rate of return through the bond fund than you would be through the market, it's really a nice added feature that you can offer your clients that most people really can't. So.
And would you recommend somebody maxing out their TFSA before their RSP account, or is that a case by case scenario?
Yeah, so that's a good question. So I mean, I think the biggest, when I look into that, I look into where, what is your available room through your RSPs. I look into where you are in your stage in life, to be honest. I mean, if you're a little bit younger, then ideally, you might want to put money into your TFSA. And the reason for that is that you're probably in a lower income tax bracket now. So So that tax deduction you get by contributing to your RSP is probably not overly that beneficial. So you might want to accumulate room through your RSP. If you're a little later in life, you probably have a higher income. So, obviously, if you have a significant room in your RSP because you haven't contributed in previous years, you can, you get a better bang for your buck tax-wise by contributing maybe a little later in life. Ideally, the most optimal situation is to max out both your TFSA and RSP every single year. But, for most people, that's not a viable option, essentially. But, so again, obviously, it's case-by-case scenario, but typically, if you need the funds, maybe in a couple of years down the line for a large house purchase or a car purchase, and having it in your TFSA makes a little more sense. This way, you don't have to pay tax on the back end when you take it out. But yeah, if you're 40, 50 years old and you're a high income tax bracket, it's nice to have that available room in the RSP and claim a sizable deduction by contributing, to your TFSA earlier in life, essentially. So.
Awesome. And just full disclosure to everyone also, Elliott is a business partner also for Mada Capital and Mada Partners. And so it's great to have him on our team to ask or to actually answer the majority of tax questions that arise through our investors.
They happen a lot too, don't they?
Yeah. And if you guys ever need to reach out to him, I'll have his contact info below the video. You guys can contact him directly on his website and go from there. But I encourage you guys connecting with Elliott. He's been a great source of information when investing in the US for myself, and it's been an asset to the company. Thanks again, Elliott, for your time today.
My pleasure, Matt. We'll talk again. Take care.